All right, this will be my trade log for February, Tuesday, the 4th, 2014. I have a disclaimer at the beginning of the video. I have this disclaimer. I'm only going to go over one or two aspects of trading here, and by far cannot cover everything necessary that you need to know to trade real money in one video. All trades are assume they're sims, and I think it covers all the legal stuff. This is my fourth time trying to do this video due to just not working out. All right, we're going to start with a 8-range chart, and that's it. There's no indicators on this chart. The green horizontal line is, or moves up, is a vertical there, but as price moves up, that is a high day. It represents the high day. The red horizontal line here represents the low day. I'm using range bars. If you don't know what range bars are, I have a video that explains what range bars are. Plus, I have you can go on the internet and find out what range bars are. Basically, this is an 8-range bar. Every time it moves 8 range in length, or horizontally up and down, or vertically up and down, it'll make a new bar. All right. The red bars always close on their lows, and the green bars always close on their highs, under most circumstances. All right. I'm going to be using engulfing trades here, so we're going to look and see what engulfing is real quick. And this is an engulfing bar long here. And what we'll do is we'll be coming down, price will be coming down and hitting the low of day, forming these range bars. And I'll have a range ticker down here in the corner telling me how many ticks of range is left in that bar that it's making now beside the red bar. I know that if this bar is going to be green, it's going to tick off and it's telling me ticks left. I know that I can place an order right above the last tick of that bar. By adding it up, there's 2 ticks left, so 3 ticks above that. Then I'd put me a stop limit order in, with zero on the limit, to get in the trade right there. And if it closes this bar, it's going to turn green, engulf that bar, and in I go long, win, lose, or otherwise. So that's how that works. It has to be touching the low of day, and it has to tick 1 tick higher up to make the green bar to fill my order. All right, the same thing with a short. It has to come up and hit the high day. It has to tick off. I'm watching the ticks. I know there's like 3 ticks left. I put 4 ticks below that. I'll put my order in, a sell stop limit order, and if this thing closes on its red, this bar here, then it'll fill me and I'll be short then, assuming it doesn't jump my order. All right. Those are what engulfing range bars are. They're only taken in this particular tactic that I'm using at the low and the high of day. That's why it's the only thing I got on the chart. Now, I did back testing on this to a great degree in other ways, but for the example of this video, I'm going to say that I went back to the beginning of this video and took every bar up, and I did it about a week ago, and I had 126 trades in all that I took at the high day and low day when these engulfing bars occurred. Out of the 126, 46 of them were losers. 80 of them were winners. That makes me, what did I have it down? I divide the, let me bring it over here and tell you. I divide the 80 winners by the 126 total trades, and that gives me a little over a 63% win-loss ratio on this particular contract month, taking into consideration that at the beginning of this thing, the beginning of this contract month, it wasn't the front month, so the volume wasn't high, so keep that in consideration there. If you're going to do your own back testing, you need to go back over a year or more of data. You need to look at, you need to write down the number of trades you won, the number of trades you lost, the number of losses you had in a row. How much drawdown did you have? And I had at one point 6 losses in a row on this. So you got to be able to have the account size to withstand 6 losses in a row. And that all has to do with position sizing and other things I'm not going to go into right now, but you have to have a big enough account to make it work. All right. So, anyway, we'll move on from there. All right. 46 of these was wrong altogether, though. So, all right. Let me see what else I have to say here. I can't remember everything. I've done this so many times. This one here happened at 4:08 in the morning. Price moved up, gave me an engulfing candle, and I would have been in at 96.85. I have a 10 tick stop on this. 10 ticks, automated strategy, automatically throws the stop on the chart the minute I'm filled. So that stop would have been one tick above 190 and 196.94 and 196.95. 10 ticks from my entry of 96.85. After getting filled, after it moves 20 ticks in my favor, I'll move my stop to break even plus 2 ticks. And you can see this is easily made, and my profit target is 30 ticks. So I'm risking $100, not counting slippage. So if you're counting slippage, you know, on average I get 1 to 2 ticks, so $120. But at any rate, I'm risking basically $100 to make $300. So a 1 to 3 risk reward ratio. I only have to be right 1 out of 3 times to make money at this. All right, and you can see that'd be 33% somewhere in there. And the win-loss ratio on this particular testing, only 126 trades. I admit you need to go back at least 1,000 trades. But at any rate, that's more than double what it is. And that's taking every one. And there is ways around the losers, you know, but you don't want to filter anything to death. I want to keep this as simple as I possibly can. And if you take every one of them, that's what you get. There is ways, if you know how to look at the state of the market and know where the buy zones are and the sell zones are, which makes things much more complicated for you to understand. If you can figure out where those are, then you can bump this thing up to 80-85% win-loss ratio, and you only have to be right 1 out of 3 times. So you know it's going to bring your profit up tremendously. But for the purposes of this tactic, I'm only explaining this tactic. I'm not going to go into buy and sell zones. All right. This morning when I got in here, I get in about 7, and I got a trade right off the bat at 7:08, 7:09, somewhere right in there. And I was in at 96.46. Now I keep very detailed records. I keep a journal. I keep snapshots with Snagit. What I'm doing here, you can also go to Ninjatator and take a picture of the image. And I write down on the chart what's going on. I say into the video what's going on during the trade and so forth. So I keep 3 different things I'm keeping track of, and I write down on the video and the snapshots how long the trade took and everything. Now today I've been trying to do this video and it's kind of screwed with my routine up. But anyway, I was in this trade approximately an hour and 10 minutes. So think about how long I was in the trade. All right. Again, my entry was 96.46, 1 tick above this golfing candle right here, in. That put my stop 1 tick below 96.35. All right, remember slippage, so you can get as much as $120 loss right there. It moves up and makes a swing high of 96.63. All right. It pulls back to 96.42 then and gives me like 4 ticks of heat. But I never moved my stop because it needed to go to 96.66 for me to move my stop. All right. It goes on up. It goes 1 tick past my profit target to limit order at 96.76 and fills me. Right now I'm up $300. All right. Now this brings me to my next thing to tell you to do, or should do. You can do whatever you like. I was distracted here. I have some family issues. I have to keep the phone by me to take calls now. But if you're in trading, you don't need to be listening to NBC or CNBC or the television period, really. You can listen to some soft music, but doing nothing that's going to distract you. The phone you have with you is there for a speed dial to your broker. If the computer fails, the electric fails, internet fails, data feed fails, you can call your broker and flatten out or do whatever you have to do to manage your trade. But other than that, it's the only reason you need to use your phone. I got a phone call. I got it wrote down here. Got it wrote down in my journal. Missed call due to lack of focus. It did work out. It would have made $300. Been in at 97.51. Stop was at 96.61. Went down, and I moved my stop to break even after 20 ticks, and bang, I was out at 7.21, and it went to 97.19. All right, next trade. Again, I got in. This trade was a loser. Trade 3. Trade 1, I'm up $300 yet, but I missed. I'm down. I should have had $600. All right, this trade here, and I didn't spell slippage right and so forth, but I had 2 tick slippage on this. I got in this trade, and within 30 seconds to 40 seconds, it came back up against me and stopped me out. I know right away I was wrong. I was down $120. Well, I'm up $180, but I lost $120 right here on this trade right here. Again, it went on up. Give me another engulfing candle. I did get in late here, as you can see. I should have been in on this green candle here. Again, some distractions. And that's what you got to do. You got to practice this in a live market with a simulator, only in a simulator mode, and to practice getting in. You can use NinjaTrader's market replay, but I prefer you being in a live market and trade, because that way there's no way of any fudging. All right, curve fitting things. All right, anyway, in at 97.62. Stop was at 97.73, or 72, excuse me, 72, one tick above the high. And it moved down in this yellow bar here, just there, because when it gets to 20 ticks, I always mark that where the 20 tick spot is, and that was the last trade I was in. And when it hits 20 ticks, I move my stop to break even, plus 2 ticks. It went down and hit my target, 97.62. So I was up 300, then I was only up 180, then I was up another 300, not counting commissions. All right, did count slippage. And it's went nothing but sideways ever since then. All right, again, I'll show you my trade management right here. You can program the ATM strategy in your NinjaTrader to automatically move this stop to break, even though I haven't done it. And profit target, so I'm risking $100, $120 to make $300. You know, worst case scenario should be $120. If you trade through a news event, slippage could be a lot more. All right, non-farm payrolls, for instance, I think on Fridays, 8:30 or something, or maybe they're once a month, I forget, but you need to know where the news events are coming out. Crude oil inventories come out usually on Wednesday at 10:30. Sometimes they'll come out the next day if there's a holiday during that week. So you need to keep track of news events. I haven't covered everything. I've covered most everything. It's a very simple method. Stop limit order. Stop limit order is you do right here. Stop limit order. I got to set a 0. It's in. Price comes down to 97.05 right here. I'm most likely going to get filled unless the market's moving really fast and it's going to jump through it. This is the order I'd place at one tick, you know, if it's engulfing down here below that to get filled. And cancel the order. Okay, so that's the order I use. And all right, and I'm trying to think if I'm missing anything else. I'm sure there is. Like I said, you need to do your own back testing. I don't care whose idea it was, yours, somebody else's, a combination of somebody else's. If it can't be back tested and checked to give you some kind of reference point where you have personally done it. Words do not teach, only experience teaches. You need to get in there and do it yourself to have a reference point. Okay, I think that's it. Trade well out there, and we'll try to make another one day.